Right. Good evening, everybody. Thank you for taking the time to come and hear this. No prizes for guessing why the registration and attendance on this particular webinar is the highest ever. I've been doing these webinars since Corona every quarter, and this is probably the largest live audience I've ever spoken to. Live. I'm here alone in my office speaking to a computer, but it's a live audience. So hopefully I'll add some value and share some insights into the current crisis. I'm going to follow a slightly different format to what I normally do, obviously focusing on the situation we're in. Interestingly, about half an hour ago, one of the younger guys in Pioneer came to my office. His shirt was out. He's looking a bit pale, been working really, really hard. And he comes up to me and he goes, "Have you ever seen markets like this? It's crazy." And I said, "Well, actually, I have. This is my sixth crisis since I've been managing other people's money. And it always feels the same. Your assumptions are tested. Fear is maximized. You worry. The screens are screaming. All the bells are ringing. And it's very natural to feel the fear. I've entitled this webinar, "The Only Certainty is There is Uncertainty." It's a little bit negative, but I think that even with the experience of previous crises, I think it's important to stay humble. I think it's important that we do whatever we can to make sure that we're taking opportunities where we see them and protecting client wealth as best that we possibly can under the circumstances. There is considerable uncertainty. Right. Let's move on. Okay, so I finished my January webinar early in January with this slide, and I just copied it across exactly. So when we were looking into 2025, we knew that there were some risks in the air. We had a sort of cautiously optimistic view, and that a lot of that had come from the positive response that the market had to Trump's election. And but we knew there were some serious risks in 2025, and unfortunately, some of those have been materialized. The agenda for today, I'm going to do a little market review. What I normally do is focus on the quarter, but I've also got data up until yesterday, and we can see, and you can have an expectation of what your portfolio did to March, and some idea for now what's happened in April. And that's more of the asset allocator view. The asset allocator view, remember, a pure asset allocator never reads the news. He allocates to equities, bonds, alternatives, and he treats each asset class independently, knowing the asset class. The backstory doesn't matter. That is the asset allocation view. All right. Then there's the economist view, which is to focus on the tariffs a little bit and understand the tariffs, why they're doing the tariffs, what are the pros, what are the cons, and more importantly, what comes next in this tariff situation. Then the last bit of the webinar, I'm going to focus on the Israeli market, and there's a lot of positive stuff there. So hopefully we'll finish on a little bit of a positive note. Okay. The first thing, whoops, why is this not moving? Okay, let's get some perspective. The S&P over the last 12 months, you can see going up the escalator and then down the elevator shaft on the right. So you can see just by looking visually, the S&P now is currently in the just under 5,000. This graph is from yesterday, but it takes us back about 12 months. So getting some perspective, and sometimes it helps to think about equity market volatility. It helps to think about it in terms of months, not percent or numbers or dollars, but just in months. So we're gone back 12 months. We've given up 12 months worth of return in the S&P, which when you get some perspective is not the end of the world, especially considering what a strong year 2024 was. And I think that perspective is important. Okay. Equities are behaving like equities. Remember, this is the asset allocation view. It doesn't matter what the backstory is, doesn't matter what the reason for the selling is. Equities behave like equities. Every now and again, statistically, you're going to have a negative year in equities. It's a fact. It's a known fact. That's why when we say when we build a portfolio for a client, we say to them, what is your time horizon? What is your maximum drawdown? Because these things happen. No one can predict them. The reasons change, but there's always going to be occasional volatility, which is the euphemism for a negative year. Another way to think about equities, I read somewhere, is it's like that dog you love that every now and again eats your couch, right? You're going to invest, you're going to love that dog, but occasionally it's going to do something bad to you. All right, as I said, to the S&P was to Tuesday, 19% off its high in December, year to date 15, and takes us back 1 year. For those of you who saw the client communication that was sent out on Sunday, I highlighted that it's happened since 1928, so it's almost 100 years. 42 times the S&P has fallen more than 15%, 42 times, and it has recovered 42 times. Again, this is the asset allocation view. We need to get confidence from that. The equity market will recover. Even now, I believe it will recover. What we don't know is how long, and we'll discuss that in a second. How long does it take the market to recover? But it will recover. We're very confident about that, and that is why we must be more in buying mode than selling mode, especially on equities, okay? How long will the recovery take? We're going to talk about that in a second. When the mix of things, in a second we'll talk about that, is the right mix, the recovery is short. And when the mix is wrong, the recovery is wrong. Think of Corona. Government intervention was immediate. The recovery was 1 month. Think of 2008. 2008 was a very severe crisis. The recovery was 2.5 to 3 years. Okay, so I've brought forward 3 lesser known or lesser spoken about crises to just refresh our memories from an asset allocation point of view. So here we've got 1987. 32% in 2 weeks. Remember, right now we're talking about 19% down. In 2025, we're 19% off our peak. Here's 32% down, and then the recovery took 2 years, okay, in 1987. The 1987 was the Russian default. I don't know, it's before my time. Then in 1998, 19% down over a 3-week period. Recovery was short, 3 months. We've seen that type of thing before. Then 2011 was the European debt crisis where Greece was threatening to leave the EU. And the market was 17% down in a 2-week period, and the recovery took 8 months. So we've seen similar sell-offs with varying recovery periods. We should get some comfort from that. What are the ingredients for the right recovery? Okay, basically it's government intervention. That's the main thing. And when I say government intervention, I don't mean the political leadership. I mean the financial leadership, right? The adult in the room, so to speak. In 2011, Mario Draghi stood up and said, we'll do whatever it takes to save the euro. That's it. That's all he said. And boom, the market started recovering pretty quickly. So when I say the financial leadership, I'm talking about the Federal Reserve or the central bank of whichever country. Here we're focusing on the United States, okay? So monetary policy is led by the Federal Reserve. They have 2 levers to pull. One is lowering interest rates, okay? So currently interest rates are about 4.25, and they can lower those and assist in restoring confidence, and that is one way. The other way is when they start buying bonds. If there's stress in the bond market, it's a big risk for the whole financial system, so they step in and provide liquidity. Think about it as financial lubrication, or whatever you want to call it. Then on the fiscal side is led by politicians. It's a little bit slower. You can lower taxes and increase spending to reboost the economy, okay? In this case, Trump plans to lower taxes. He's got to get it through Congress. The process is longer, and he wants to finance that with tariffs. But that's part of the plan. And getting spending going with the deficit, they're trying to save money through Elon Musk's efforts, and then they want to reallocate that money. But they're not really going to cut back expenditure. On the monetary policy side, the concerns are inflation and unemployment. If inflation is too high, then they're reluctant to decrease rates. And that's the situation we're in right now. Inflation has come down a bit, okay? The pressure is up from tariffs. Tariffs are not necessarily inflationary. All other things equal, yes, tariffs are inflationary. But for example, we've seen gas prices go down from $70 to $60. So there's other mitigating factors to reduce inflation. So overall, inflation may not jump up. It's certainly not going to do what it did in post-corona, but even 0.5% is a lot. We're not expecting that type of increase, but the pressure is up. What does that mean for the Fed? They're reluctant to lower rates. They've said they'll lower rates later this year, but assuming they're politically independent, which is a big assumption, they're not going to rush to lower rates. So we're not expecting massive Fed intervention. On the bond buying side, yesterday we saw some stress in the bond market. I'll go into that in a second. And if that increases, then they will step in sooner, because that they can't mess around with. They can't allow bond spreads to widen too much. They need to step in there. And that's less, that could be faster than an inflationary interest rate intervention. Fiscal policy concern, that takes time. It's got to come through Congress. And their concern is budget deficit and the overall debt levels. They don't want to be feeding those problems anymore. So the question is, will that old playbook work to restore confidence? Yes, I believe it will. The timing is unknown, but I believe it will. The other alternative is if Trump suddenly reverses the stance that he took on the 2nd of April. I do not believe that he's going to do that. I believe he's ideologically committed to these tariffs. He's done his homework. He has enough support. That support will be tested, but he has enough support. So I don't expect that either. So maybe we're not going to see such a fast rebound. Interestingly, one of the experts who I follow and listen to, he's one of these technical trading guys. He was saying that from a technical point of view, they look at statistical things like that, they are predicting a faster rebound. I'm a little bit skeptical, but it was encouraging to hear at least the technical analysis support a quicker rebound. From my point of view, investors need to be patient. It's going to take time for the dust to settle. There's a lot of uncertainty, and that's the key word here, be patient. Let's have a review of index performance. Okay, so I've got here the quarter, then I've got year to date, including yesterday, up to the 8th of April, and then the last 3 years, right? These are the major indices. S&P 500, -4 to the end of the quarter, not bad at all. -15 to yesterday. So you can just see how how quickly that dived down. NASDAQ, -7 to the end of the quarter, -18. Both NASDAQ and S&P are positive for 3 years. Remember, the 3 years includes most of 2022. 2022 was a terrible year. So we've got sort of 2 crises in 3 years, and we've still got a positive result on the S&P and the NASDAQ. Again, this is the asset allocation view. MSCI World, which is global indexes, it's +12 over 3 years, -11, and -1 to the end of the quarter. So Europe was doing pretty well in the first quarter. China was doing well. It was America that suffered in the first quarter, and then in April gave it all back. So that gap closed. Tel Aviv is unbelievably strong, really. Hardly moved in April, pretty strong, positive result. Everything else is negative, and that's in shekels. Last 3 years, Tel Aviv Stock Exchange has done similar to the S&P over the last 3 years. Really, really positive. China, +15 to the end of the quarter, flat to yesterday. So whatever gains they had in the first quarter, gone in the first week of April. Last 3 years, -1. China has not been a great place to be. Lots and lots of volatility. Global bonds have done their job, okay? They've provided ballast and stability in the portfolio exactly at the time that you need it. We call that asset allocation. Asset allocation worked in the first quarter. So positive returns from bonds. The 3-year view on bonds is still suffering from 2022 when interest rates shot up. But at least this year, bonds are doing their job. Conservative investors can be completely relaxed. Treasuries, which are government bonds, Also, even better story, stronger performance than corporate bonds. Similar story on the 3-year view. It's negative, still suffering from 2022, but this year bonds have been fantastic. Israeli bonds, less good, okay? Israeli bonds typically have a higher equity correlation than global bonds, so they do kind of express risk a little bit more, but it's very small numbers. And then I've put in here Tesla, just because it's so interesting. Tesla was down 31% for the quarter, 45% to including April, the first week of April, and 35% over the last 3 years. So in December, we said that Tesla was hopelessly overvalued, I thought. Funny enough, I've seen analyst reports saying Tesla was a buy in December. Unbelievable. I'm sure that guy is being a bit quiet right now. Okay, let's start looking at some of the reasons now. As you know, Trump announced on the 2nd of April reciprocal tariffs. And the key word is reciprocal, because we're going to dive into it and you'll see. The base tariff was expected, but what we didn't expect was the additional, the size of the additional, and the breadth. The fact that he took on the whole world on that one day, that was not expected. Maybe the market didn't take Trump seriously, because he did say during his election campaign he's going to do this. But the way he rolled out this program, let's just say, leaves much to be desired, or can be criticized, is the most diplomatic way I can say it. It's a bad idea to shock the market like this. I'm sure he could have done it in a better way. And the big thing is policy uncertainty has created confusion for businesses and spending holdback. And this is the immediate pain is this holdback of investment, holdback of decisions, holding back spending. This is what we will feel immediately. We're going to see it in Q1 numbers, and now we believe we're going to see it in Q2 numbers. And this is what we think the probability of a recession has gone significantly up. We shall talk about it. Growth confidence. A big part of equity market valuations is your assumption about growth. If your assumption about growth is high, it justifies high valuations. If your assumption about growth is low, lower valuations. So growth confidence gone. The issue of, is this a correction or is this a crisis? It's a little bit of both, in my opinion. We use the word, the market use the word correction. I hate that word, because in my opinion, the market is always correct. There's no such thing as the market being incorrect. The market is where a willing buyer and a willing seller meet, and it's always correct. But we use this term as a euphemism to justify the first 10%. When the market is high, the first 10% disappears, and we say, oh, it's a correction, okay? From then, you can say it's a crisis. So it kind of mentally helps to break it down, because the market was high, okay? The market was overcooked, and in retrospect, at least. And so part of it is a correction, part of it is specific to the growth uncertainty. It needs to be said, it's not over, right? There could be another leg down. One of these statistical traders that I was listening to, he seemed to call the bottom at 4,800 on the S&P. We're at 4,900 and something, so another 5% or so. Again, statistical stuff doesn't mean anything, but encouraging to see somebody call what they believe is the floor. One never knows. No one ever rings a bell at the bottom. No one ever rings a bell at the top. And one needs to be patient, but by no means this is not over. Big question is American exceptionalism. Now, we at Pioneer, we've had a favor, we've looked favorably on America and we've always believed in American dominance. And the question is, has this view changed? And it's a cautious no. We don't believe it's changed. The American economy is only 14% imports, right? So there's still 86% of the economy that is locally orientated. So that should be one reason. It's still the best, the deepest economy with the most money, strong democratic background, strong legal background. So it's got all these fundamentals for growth, innovation, skill, talent, whatever you want to call it. So we still think America, one way to look at it in this current crisis is it's the cleanest dirty shirt. So I would still like to have America's economic problems than most other countries' economic problems. So it's a little bit of a flip side of looking at it. The AI theme is still relevant. It's a little bit threatened. There was a Chinese company, but the technology is nowhere near what the chip technology is nowhere near what NVIDIA is producing. Remember, the main AI companies are owned by the big four. So ChatGPT, which seems to be growing on a daily basis and taking Google's market share, that's actually mostly owned by Microsoft. So through the S&P, through our mega cap exposure, we've still got exposure to AI. AI is not disappearing because of tariffs, right? It's going to be around and it's going to change the way we use the internet. Inflation is bottomed out, and I explained about tariffs are not all one way on inflation. There are mitigating factors. And interestingly, and of course, the whole market mood has changed from December till today. Bonds offer relative stability, and investors should take comfort from this, all right? The 10-year benchmark, which moves the prices of bonds, went from 4.5 down to 4, and then suddenly yesterday went to 4.4. I think the Bloomberg headline was bond market craters. So they use the word craters for a movement on yields from 4.0 to 4.4. Now, in the bond world, that's a lot, okay, especially for one day. But yesterday, somebody, we're not sure who, somebody sold a huge amount of US treasuries. Maybe it was politically motivated by China. Maybe it was a hedge fund that was forced to unwind positions. Maybe, who knows? We don't know who the seller was, but we know somebody dumped on the market a huge amount of 10-year treasuries. And when you sell, you push the price down, which pushes the yield up. So other than that, which you could see in the table of numbers, the treasuries from an investor point of view didn't change that much. But there's still good stability in bonds, and the negative correlation to equities is working. So we should get comfort from that. Okay. The bonds obviously contributed positively to the portfolios. Now, corporate spreads are widening. Okay. Still tight by historical standards, but they're widening. What does that mean? It means if you're an investor who's sitting in cash, now, if spreads are super tight, you could buy a quality bond, but it's not going to give you meaningfully extra return. If those spreads widen, you can buy a high quality bond and get another % over what you would on cash. Okay. Remember, if you're sitting in cash, now's the time to buy equities. But if you wanted to remain super conservative, then you would buy bonds and have a pickup over cash. Okay, let's go into this kind of like the macro story now, move away from the asset allocation story. I think it's very important for investors to understand why Trump is doing this. I'm not taking a political stance here. I'm not defending Trump. As I said, the way this was rolled out leaves a lot to be desired. But I do think we need to drill into the reasons why they're doing this. If you read the normal press, it's one-way criticism, and they don't bring up the flip side of the argument. For anyone who wants to, I encourage you, read this. I don't know if you can see it, but it's if you go to the White House website, just put in Google White House executive orders, and you go to the executive orders. There's two documents there, one called the fact sheet and another explanation. I encourage you to read these, because this is the US administration, not just Trump, explaining why they're doing it. Okay, and a lot of it has got to do with unfair trade practices. All right. So the world of global trade is neither fair nor free, right? When we talk about tariffs, and the press does this a lot, they act as if the world has a completely free market and suddenly, boom, Trump is putting in tariffs. That's not the case, okay? The world of global trade is messy. There's a lot of dirty tricks that nations play against each other in the world of trade to block overseas competition and protect their local industry. Almost every country does it, These dirty tricks is one of the big reasons why Trump is doing this. Now, prior to this, you had organizations like the World Trade Organization, and their job was to negotiate these obstacles and try to reach an agreement between different countries and companies. Okay, so Trump's logic: if America is strong, the world is strong. If America is weak, the world is weak. There's a lot of truth to that statement. Okay, there's a lot of truth. America is the largest economy. It's the richest economy. They spend the most money. And if they are weak, the whole world will suffer. Make no mistake. Examples of these dirty tricks that are happening. Okay. So for example, if you want an American meat exporter wants to send meat into either England or poultry to South Africa, which is specifically talked about in that the country, the South Africa or the UK or other countries, also Japanese seafood, they have all these health restrictions and other restrictions, and they make it almost impossible for an overseas company to sell food into that local company, right? So these are barriers to free trade, all right? The European Union have a number of obscure legislation which is selectively imposed. So, for example, there's a current attempt to fine Apple, Meta, which is Facebook, and X, which is Twitter. There's an attempt to fine them for their lack of protection on under 18-year-olds, okay? Some data privacy issues, some antitrust issues. So they're attacking the three largest social media providers and computer provider in Europe, okay, which are American companies. They're attacking them. But China's TikTok is not listed for fines under the same thing. And anyone who knows TikTok and Facebook is for 25s and above, and TikTok is for 25 and below. So there's some seriously suspicious stuff going on there. And there's other regulations that Europe has. They have things called the Deforestation Supply Chain Regulation, which basically makes it impossible for American agricultural firms to export into Europe. They have a thing called the Carbon Border Adjustment Mechanism, again, making it impossible for American companies to sell into Europe. These are barriers to trade. There's currency manipulation. Israel does this. The Bank of Israel intervenes to protect the shekel, because if the shekel's too strong, the high-tech industry will suffer. Now, that's services, it's not export, but countries do that. That is a trade mechanism designed, it works like a tariff. Subsidies are another example. Chinese government will subsidize a manufacturer if he gets into trouble. Another one is environmental law or labor law. So maybe some Chinese factory is polluting the environment, and some American factory making the same good is subject to environmental restrictions, and therefore they can't compete. So in Trump's table of tariffs, they've tried to calculate the value of these type of tricks. Dumping is an old one. The Chinese are mainly responsible for that. Intellectual property infringements, also lots of accusations against the Chinese. So it's not just about tariffs, all right? Trump's view is, you want to trade with us, you want to sell your product in America, go for it. You want free trade? Fine, but free trade is free trade. You can sell your product in America if we can sell our product in your country. If you block us, we will block you. That's the mentality behind this tariff campaign. He believes America will make a lot more money from different sources and be much stronger if trade was indeed fair. So he's using tariffs to counter these other unfair practices. Tariff goals. Funny, I don't know if you've seen, there's a social media thing, AI developed these really overweight Americans sitting in a little sweatshop sewing shoes or t-shirts or something like that with this very sad Chinese music overlay. I don't think it's about creating jobs like that video is teasing. It's more about stopping the trend, right? Over the last 20 years, America has lost 3.5 million manufacturing jobs, right? If they can stop that trend, never mind recreate factory manufacturing jobs. If they can just stop the trend of factories closing and moving offshore, that will be a success. So one, they want to counter these unfair trade practices. They want to make more money for America. So tariffs, at the end of the day, certain products will get sold. They'll be more expensive, but there'll be money for America to finance other things like tax reductions for the citizens. American jobs I spoke about. And the middle class in America is shrinking, okay? It's mainly becoming poorer. Some of it got richer, but it's shrinking. And this is a strategic threat to America. Trade deficits ultimately have to be financed. They put pressure on the currency, and they ultimately filter through to debt levels. The US debt is a strategic problem for the world. I'm going to talk about that in a second. All right. Then the last reason is he used tariffs as a bargaining tool to enforce policy. So he's trying to stop the Canadians allowing the drug trade into America, and he's using tariffs to enforce that. Criticisms. Now, anyone who studied economics at any school was taught globalization and free trade is better than a protectionist approach. Everybody learned that, right? And a lot of people are being virulently critical of Trump, what he's trying to achieve, the way he's trying to achieve it, and the way he rolled it out. But the criticisms are valid. Creates uncertainty? Absolutely. We're living it. Potentially leads to higher prices for consumers. Yes. All other things equal? Absolutely. Overall inflation, but certainly certain products are going to be more expensive. Disrupting supply chains? Absolutely. Complete Control-Alt-Delete on certain supply chain areas. It invites retaliatory tariffs and other policy measures. So maybe some of these unfair trade practices are going to get stronger. And we've seen China double down on retaliatory tariffs, and Trump double down again. So you've got this negative spiral happening. And all of this may ultimately hurt US exporters. Okay. Will it work? Will it be destructive? Only time will tell. We don't know at this point. I think let's talk for a second about what comes next with this tariff drama. I really don't believe Trump is going to back down on the 10%. He may back down on the other stuff. He may do individual negotiations. He's going to hold out as long as he can. The reactions are hostile. So we've seen China's reaction. Europe have been a little bit diplomatic. They said 0 for 0 on industrial goods, but the European way is slowly. It's going to take time to gather the consensus amongst the 27 nations that make up the EU. I think it's going to put a lot of stress on the EU because Italy wants to trade with the US in one particular way, and France wants to trade with the US in another particular way. And it's going to be very difficult to build that consensus view on how to respond to Trump's tariffs. So watch out. There could be serious pressure on the EU. China have doubled down on tariffs, and I don't know what comes next. As I said, non-tariff protections, privacy and data protection laws to block USA so they can do more things against Facebook and X and Apple to block their success in the EU. Interestingly, the EU has a mechanism called the anti-coercion instrument, which is kind of like a planning tool for an event like this. If they enact that, they may target intellectual property rights, services, and procurement. They can really fight back if they want to, but it's very negative, and it creates more uncertainty. So we hope that they won't go that path. China dumping goods. So for example, a Chinese company that once was going to sell into the US, but can't get into the US because of 100% tariffs, might dump those goods on Europe. That could be very bad for Europe, and Europe will start to protect itself. So everybody starts backing up, and that creates more uncertainty. Interestingly, on the 2nd of April announcement, 3 major industries were excluded from tariffs: pharmaceutical, lumber, and semiconductors. Maybe because they're so big, maybe because they're contentious, maybe they're being held back for a second stage of negotiations. We're not sure, but currently those are out. Pharmaceutical would affect Teva, could affect Swiss companies like Roche. And maybe there's a stigma around taxing medicine that Trump's avoiding. I don't know. I think one of the biggest risks that Trump faces is Republican defections, particularly in Congress. The pressure of the market crashing may make so certain Republicans switch sides, or at least back away from this drama. And I think that that's a very real risk. The midterms are a year and a half away. So whatever happens, Trump has to sort this out by then. If we go into midterms in a year and a half and the market hasn't recovered and there's some sort of prolonged recession, then Republicans will lose their seats in Congress, and the margin is small, and it'll be catastrophic for the Republic for the last 2 years of Trump's presidency. Legal challenges. Trump invoked these powers under some obscure regulation, quoting national emergencies. These type of things are supposed to come from Congress, but he's done it under law, and it's going to be challenged. And who knows what the outcome of that will be. So the obvious question is, will there be a recession in the USA? We, within the registration process here, received this question about 10 times. And I think that 2 months ago or a month ago, we said, yeah, it could happen, low probability, 10 to 20%, market's not pricing it in. And I think the situation now is it's the base case. I think there will be a technical recession. From Q1 might be minus, Q2 will be minus, Q3, I'm not sure. By then, hopefully, interest rates would have come down. So I think we're going to face a recession. How do you fight a recession? The same way you fight uncertainty in the markets. I explained this in the beginning. Monetary policy, fiscal policy. You want the adult in the room to say everything's going to be okay. The market doesn't wait for the economic data to tell you we're in a recession or not. That data comes months down the line. The market wants to know now. So that's why it needs that adult in the room to say everything's going to be okay. What does it mean in terms of investments? In a recession, equities trade at lower multiples, all right, and companies make less money. So equity market down. In the credit side, spreads widen. So your quality credit starts producing higher returns, and your risky credit, your high yield bonds, you can expect some defaults there. The good news is, okay, that a significant part of that recession risk is already in the market. And I'm going to show you a research piece from Goldman Sachs that came out yesterday. All right. So what we've got here is 4 blocks. What they're doing is they've averaged the market reaction to recessions. Okay, so they've taken the first block is all recessions, the second block is all recessions without 2008, and the third block is a mild recession, and the fourth block in red is our latest sell-off. So they're saying intraday peak to trough minus 21. Okay, you can see visually that that's a significant part of the expected recession. The market, the stock market is saying, yes, there will be a recession. We're selling now. Bang. The damage is mostly behind us, okay? That's what this research piece is saying. Hopefully it's correct. I mentioned the US government debt earlier, and this is a strategic concern of the world, not just of America. If America doesn't get control of this, the whole world will suffer. Tariffs is one way to get control of this, all right? You measure debt by debt to the size of the economy, so in relative terms. And in relative terms, the US is at the World War II levels of debt, all right? It's large. $36 trillion is the number. What we've learned from Elon Musk's Dodge efforts, whether you believe it or not, will be a political thing. But even if it's half true, all right, we've learned that the USA does not have the controls that we thought they had. There's a tremendous amount of wastage. And what we've also learned is extremely difficult to meaningfully bring that debt down. Long term, the only way to get control of this debt is to allow a little bit more inflation. Okay, so let inflation tick between 2.5% and 3% over the long term. Keep control, try to stop that deficit from growing, at least maintain a budget, a neutral budget, and not add to it. Okay, what does that mean for investors? And this is very difficult for private clients to do. But if you had a 20-year time horizon and you could close your eyes and invest 20 years into the future without measuring volatility, without worrying about crises, then you should have much more equities in your portfolio, because equities will have a better chance of keeping up with inflation long term. And I'm saying this is a 20-year view than any debt instrument. Debt is to help you manage short-term volatility. Investment implications for investing in a period of uncertainty like this. One, be patient. You've heard the asset allocation view, and we firmly believe it. The S&P will recover. When? We don't know, but it will recover. Bonds offering good stability. Alternative investments, which we do have in our arsenal, have done very, very well. They don't mark to market, so they're stable. Okay, the risks inside, we need to drill down and make sure that they're conservative, and our alternatives are. And then structured notes is another way to play the volatility, to get some protection, right? You give away some of your upside, but you also get some protection. Okay, let's just finish off with something positive back on the asset allocation. As I said, this is my 6th major crisis. That's why I took this graph from 1st of January 2005 through to the 7th of, which is Monday. Tuesday won't make a difference on this graph, I promise you. But over this period, the S&P has produced 9.46%, and it includes 6 different crises. 2008, global financial crisis. 2011, European credit crisis. 2018, Trump won with China. 2020, Corona. 2022, Ukraine and inflation. And now Trump tariffs. 6 major crises in these numbers, and you still return 9.46. My assumption going forward, I always choose a more conservative number, but 7 or 8% for equities going forward is what I believe. If we could jump forward 20 years and look back to now, I believe we're going to have 7 to 8% in the S&P, hopefully more. Okay, that's all on that. We're going to now jump. How am I doing for time? I'm running out of time. Okay, we're going to do the Israel economy pretty quickly. It's mostly good news. We've got a budget, which is not trivial in Israel. Sometimes the budget is passed after the year is finished. No meaningful incentives for getting the Haredim to work. No meaningful messages about saving money. The good news is the government budget deficit is 5.3%, which is excellent. It's down from 8%. It's still a budget deficit, but it's down. The war is still going on, and we're still spending tons of money, and we've got control of the budget deficit. And the debt to GDP is 67%. A year ago, we were predicting that to be 72, 74%. So say what you want about Bibi and Smotrich, at least from that point of view, they're doing a half-decent job. The growth expectations in Israel are pretty strong, 3 to 4%. America's not going to be near that. Europe's not going to be near that. Japan's not going to be near that. So those are very strong numbers from the Israeli economy. Property, I mentioned this in the previous webinar. The war has caused a delay in delivery of property projects. So the demand over supply gap has widened. This should give support to property prices going forward. It's good for property owners. It's bad for property buyers. The gap between mortgage payments and rentals has also widened. So we're expecting, a lot of Israeli rental agreements renew in the summer. We're expecting a jump up in rental. That's inflationary. It feeds through to inflation data. So don't expect interest rates to come down. And if you're renting, expect your rent to go up. More miracles for Israel. Local equities are still looking cheap relative to the S&P, even after the sell-off. Tel Aviv top 30, the biggest companies in Israel, are not affected by the tariffs directly. Israeli financial services companies, whilst very profitable, I can't speak about the services that you will get from them, but at least they're very profitable. They're making 15 to 19% on their capital. A deal with Saudi Arabia is on the horizon, which is extremely positive and has a lot of positive issues. Security threats are at their lowest. there was the whiz sale to Google, which is $32 billion. I mean, that's going to introduce a few hundred new millionaires to Israel and quite a significant tax income, and will contribute meaningfully to GDP. So that's very positive. Shekel dollar, got lots of questions about this in the registration. I've explained this before, that there's a long-term correlation between the stock market and the shekel, and this is because of the huge amount of money that Israeli institutions are managing in the S&P. They have to hedge their shekel exposure. So as the S&P goes up, the shekel goes down. As the shekel goes up, they're buying shekels, and it goes down. This has been it's a pretty strong long-term correlation. It broke down a little bit during 2023 political reform and during the war, but it was reestablished of late. So we saw the S&P go from 6,000 down to 5,000, and we saw the shekel dollar go from 355 to 380. I think it's at 382 today. So basically, what that means is if you're sitting on dollars and you need shekels, now is an excellent time to convert. An interesting point I said earlier about currency manipulation in Israel, if the Bank of Israel steps in to defend the shekel, then that might be frowned upon by the Trump administration. So maybe we'll see when things calm down, we'll see the shekel strengthen a little bit faster than it normally does. Maybe, don't know. My crystal ball, I think I've mentioned some of these points. We're in a new world order, okay? There's a lot of uncertainty. Trade has been thrown into complete turmoil, and there's going to be consequences. Like all wars, the trade war has unforeseen consequences. Some of them might be good, we don't know. Some of them might be potentially disastrous. My big fear is the second order consequence that we can't see right now. We're trying to establish what that might be. Maybe it'll be nothing, but that's my big fear. The unforeseen consequence that, for example, breakup of Euro because they can't agree how to deal with America. That could be the type of second degree consequence. Uncertainty means volatility. So investors need to be patient. Your portfolio is going to go up, it's going to go down a little bit more than it used to. You need to think long-term, particularly on equities. It's now time to buy. My team worked like mad over the last few days to buy some S&P. It's not the time to sell. It's not the time to de-risk. If you're scared, you can put your cash in quality bonds, but do not sell equities now. Fundamental assumptions are still intact. The world's not ending. Capitalism's not ending. We will get through this. Bonds are appealing. And unfortunately, this trade-based drama is going to be with us for the next 4 years. So we need to get used to it. Okay? Unless Congress flips. Let's deal with some of the questions that came through in registration. How low could markets go? No one knows the answer to this. I mentioned the technical guy who said another 5% potentially. I have my nightmares from 2008 when we had roughly 30% up until Lehman went bust. Then Lehman went bust and it dropped another 20%. So that second order is what concerns me. I don't think it's going to happen, but that's what concerns me. Europe, I mentioned. Japan, Korea. Korea is not really on my radar. Investing in Japan is complex because of the currency. To hedge the currency is very expensive. It's roughly the difference in interest rates. Interest rates in Japan are like 1%. Interest rates in America are 4%. It's going to cost you 3% a year to hedge. And if you look at the difference in return between the Nikkei in yen and the Nikkei in dollars, you get massively different results. Do you recommend investing in the S&P 500? Yes, I do. What do the shrinking public equity markets mean for private equity chances? I think right now, whatever IPO was planned, it'll be delayed. Interestingly, one of the things that Trump has promised is deregulation. Now, deregulation is a big deal. The regulation is choking growth in America. If he's successful in deregulating, we'll see more IPOs, we'll see more M&As. This will be positive. So hopefully one of the fiscal counters that we hope to see in the future is deregulation, which will lead to more IPOs. If you were doing an IPO now, you'd wait for a more stable market. We talked about a recession. Is gold a safe investment? I don't like buying gold at $3,000. the word safe is funny because gold is so volatile. Gold is more volatile than equities. Okay, so is it a safe investment? No. If you buy it as a protection asset, you need to buy a lot. You can't just buy a little bit, and you really need to think 40 years into the future, not even 10 years into the future. So no, I don't think gold's a safe investment. While you hold it, you don't get a coupon. So if you want a safe investment, buy US treasuries or cash. Should we consider fixed deposit because of the uncertainty in the market? It depends where you're coming from. If you're coming from cash, then if you've got an appetite for risk, buy equities. If you're scared, then you can buy bonds. I wouldn't sell equities now, okay? What does it mean for our portfolios? It means to be patient, okay? We're looking for opportunities. As I said, we bought stuff yesterday, and we didn't buy anything fancy. We bought plain vanilla S&P, right? Nothing too esoteric. It's very difficult to get the regions and the sectors right now. So we're just going with S&P. Tariffs on the Israeli economy and inflation. Tariffs right now are not a big deal for Israel, hardly affecting the economy. Inflation, I mentioned the rent thing. Stagflation is an interesting subject. I don't think we're going to have stagflation is low growth or negative growth and high inflation. We're not going to have that in Israel. In the US, it would be short-lived. I don't think we're going to have it. Inflation is not going to break out from 2.5 to 3. So to have stagflation, you need a breakout in inflation and low growth. I don't think we're going to have stagflation. If we do, the Federal Reserve has ways to deal with that. How much time for markets recover? I don't know. And that's a point I make, but it will recover. I think we must emphasize that point. The market, I believe, will recover. We just don't know over how long. And is the effect of tariffs reversible? This is a good one. Which effect? And I think the market side is reversible, yes. The political damage and the relationship damage between countries, that's going to take time. Just for example, in Canada, they're having an election in 2 weeks' time. They've got Mark Carney, I think his name is, who's the new Liberal candidate. He was the head of the Bank of Canada, the Central Bank of Canada, during the 2008 crisis. So he's an economist. I wouldn't want to debate tariffs with him, but he's a Liberal and he's anti-Trump. So if he wins, then Canada is going to be very much double downing on this showdown. If the conservative guy wins, then at least him and Trump can have a better conversation. So there's going to be these second order effects. So are tariffs reversible? I think on the market side, yes. Relationship wise, it's going to take time. It's going to take time. Okay, let's have a look if there are more questions that have come in. Hold on 1 second. I got a specific question about Tesla here. I'm not a Tesla expert. I'm more of an asset allocator. Is Tesla a buy? I actually don't know. I'll get you, if you want, email me after, I'll get you one of those analyst reports. But there was an analyst report from December that said it was a buy at 3 times its current price. So maybe yes, but it certainly is a risky buy. And while maybe, let's see what if Elon Musk, Trump stay together. There's some definite shaky ground there. Okay, that's a wrap. I hope you enjoyed. Thank you very much for the time. And Chag Sameach to those who are celebrating. And we look forward to calmer days. Thank you.